volatility versus certainty, and how you achieve higher returns while still protecting your capital. I'll draw your attention to the slide on your screen, which is just a general disclaimer. We're talking generally today only, and we shouldn't be construed as giving advice. We're going to speak about 3 topics. The first one is show you volatility across different asset classes. What actually is volatility and why is it important? And thirdly, how mortgage funds like M Squared Capital can complement your portfolio and create the certainty that you are looking for. So M Squared Capital, who are we? We're a private credit provider. I'm Paul Miliotis, Managing Director and Joint Founder of M Squared Capital. I have with me a good friend and a business partner that's been with me for a very long time, Joint Founder and Joint Managing Director, Paul Miron. We provide self-directed investors like yourselves the opportunities to have exposure to mortgages. So quite simply, we're debt and property specialists. What is volatility, Paul, and why is it important?
Okay, so one way of looking at volatility that I want to go through today is imagine a pendulum swinging. Okay, so if we, for example, look at the share market, for example, for the last 100 years, the ASX 200, if you have the pendulum, it goes up into the positive territory and it goes down through to the mean into the negative territory. If you look at the 3 most significant positive events that's happened in the share market, we've had in 2009 a 39% growth after the GFC recovery. You've had 1950, which is fondly named as Nifty 50. You had 1 year that it had returned 32%. And then you had 1993, for example, 27%. 1933, it returned 23% after the Great Depression. Now so what that gives you is the possible most positive outcomes that the share market has given investors over a 100-year period. But then let's look at the worst 3 events. So you had the 2008 GFC, share market fell 40%. You had the 1974, which was an oil crisis, not too dissimilar of situation that we're going through right now. It fell 26%. And 1930, right before the Great Depression, it fell 28%. So by understanding how the market, how each particular asset class swings up and down, it gives you the possible events that you could have in holding a particular asset over a period of time, which is quite important, and understanding the behavior of it as well.
So that's shares, Paul. Let's
That's
move
right.
on to another category, which is corporate bonds.
That's right. So look, corporate bonds, it's a debt instrument. Now, this is not, these stats that are put on the screen are not of actively trading bonds. The long-term sort of returns. And you can see that because it's debt related, it pretty much positive, but it doesn't swing as high. So there's more certainty, it's more closer to the mean. It's more closer to the center. And so that if you have a conversation in relation to volatility versus certainty, well, the volatile asset can give you higher returns, but less volatile asset will give you a lower return over a long period of time, but it's more stable in that respect.
Yeah, not just higher returns, it can also have a market shock like we've seen.
That's right.
That can go negative too. So I think the volatility can have big positives, big negatives. Less volatile, it's defensive against volatility is what we're saying, right?
Now, the third asset class that we want to try to talk about is property. Now, look, we've only looked at Sydney property in this particular example, and there's 3 positive events. It swings up to 25%. The last 12 months has done really, really well. 2015 has done really well. 1998 was an exceptional year. That was 39%. There's many reasons for it, but it can go high. Direct property was also a great asset class. On the flip side, how does it behave when it goes down? Well, actually, quite interesting enough, it doesn't actually fall the same way that it actually goes up. So 1990, it fell by 17%. 2018, it was very similar at close to 10%. And 2011, it all fell 8%. So it actually, what it shows you as an asset class, it can have the really big increases, but when it does fall, it's actually quite modest, and it probably goes flat for longer as well.
Look, with this particular one, it's very close to our hearts, and we analyse volatility in our sector for a very good reason. When we are lending money against property as security, we need to know how volatile that property is. So we are predominantly secured against property in Sydney. So if we have $1 million property and we lend generally in M Squared 65% or below, so $650,000 against $1 million property, for our investors to lose money, the property would have to drop by 35% or thereabouts. you can see on this pendulum that the max in the last 100 years decline was give or take 17%. So we think that's an adequate buffer historically. Now, not saying that it won't happen, but historically in the last 100 years, our investors should be recovering their money every single time. And that is why understanding volatility in the sectors that you are invested in is crucial.
It's a deeper understanding of risk, and it's about more predictability. It gives you some certainty in relation to predict the future as well. So the next graph that I want to show the viewers as well, we mapped out the ASX 200 over the last 10 years. Hypothetically, M squared capital, which our average return, if you invest in every single loan that we have in our fund at the moment, your average return would be slightly higher than 8%, and corporate bonds. So you can see that the returns are invariably different. Look, the Australian stock market has done great, and it's a great performer. The reason why we have this graph over here is I want to play out a hypothetical. If you have a market crash as of significant as anywhere in between what we had previously experienced, those three events that I mentioned, what would that do to your average return? Yeah, well, the average return right now is 10.8% over 10 years.
10.8 if you did a 10-year mean, right? Yeah.
But if you had an event such as that, your returns would be close to 4%. So that's important to know there. Now, look, when it's not a conversation for you not to be invested in shares, but it's a conversation to actually think about, if that event happened, does your portfolio have enough diversification? Do you have enough of a time horizon to wait for it to recover? And thirdly, do you have enough income as well? So those are the things that come out of that particular graph. The other interesting thing when we talk about risk, if we look at the Shiller Index report, which is quite interesting, that Robert Shiller has actually worked out the PE ratios of stocks in America and Australia over the last 100 years. Now, what he actually found is that when the ratio is above 20, there's a higher risk of the market to go into downfall. However, the last time that we've had this index close to 35, we've had 2 out of the 3 major crashes that we mentioned before. So that's another interesting way of looking at it.
Where are we are now? So
well,
you've talked about the...
Well, America, the US at the moment is at 30, to be exact, 35.75, which is very high. Australian share market is at 20, so it's at the higher level of risk as well. It's just great to understand and look at these type of things to understand, well, how much risk there is with my asset class. And that's a really nice way of looking at it.
So what you're saying, share specific right now, we don't know when there would be a correction or a market crash, but be mindful that this forecast is saying that it could happen sooner rather than later. Now, it is a forecast.
And it's really a nice measure of volatility as well. So look, the study of volatility allows you to predict outcomes for different asset classes, so that we have, and these are controlled by the macro. But what can you control, which is the micro? And this is something that we want to discuss a little bit more detail. Okay? The question you need to ask yourself, is your portfolio balanced enough to withstand a shock? And also about decision bias. It's like, some people are very used to one particular asset class versus another one, and looking at volatility gives you a better understanding in relation to having a good combination or spread or diversification between different asset classes, so that your portfolio can behave in a superior way over a long period of time.
Now, we've talked about decision bias in our office. I mean, we're in mortgages, we love mortgages, but we're still invested in stock. People that are invested and not diversified in one or another are doing themselves a disservice because of that bias.
That's right.
So, for lack of a better word, you've got to grow up and get over it and look at the fundamentals, so you're able to give your portfolio the best returns possible. So now we get into the meat of where we're coming from as mortgage fund managers. How do mortgage funds like M Squared complement your portfolio? Investing into mortgages provides you the certainty of regular income. We're a natural hedge from volatility. So you remember the graph that Paul had prior that showed the consistency. That's what our investors bank on to live off in times of volatility. So it's important that not all mortgage funds are the same. It's up to you to do the due diligence that you understand what mortgage fund you are getting invested in.
Yeah. So look, we talked about, we actually talked about volatility. We talked about the micro in relation to the quality of assets that we actually choose. a lot of people think that the only question that we ask is about the security. There's a lot more to it. In order to actually have quality mortgages, you look at other things than just the security. So let's go through it. You look at the character of the person. Is a person of good character? Okay, we do a lot of searches. We understand who that person is, even if we've never dealt with them before. It's really critical to us as well. If something happens and the person's under pressure, will he still obligate and honor his word? This is the most important question you need to ask of someone's character. Capacity. Capacity is much more deeper just than looking of their balance sheet. Is that, do they have liquid assets? So you don't want to be lending to someone if that's the only asset that they have. You want, if something happens, you know that they can liquidate other liquid assets to ensure to continue to paying your mortgage in an event that may be unforeseen. Cash flow. We want to make sure that our borrowers are able to continually paying us the cash flow that our investors rely on a monthly basis.
Well, our investors, that's how they earn their income. So
right.
they're sharing the interest income that our borrowers pay. So critical.
And once again, competency. So, you know, it's a historical 3 questions. Why do you need the money? When do you need the money? And what security you have? You really want to know why he needs the money. Like he needs, whatever he's using our money for, our investors' money, he needs to be competent on. Because if he's not making money, we shouldn't be lending money to him.
So as an example, if you're using the money to shore up your business, how's the business going? The competency of the business is actually operating.
That's right.
And the last and very important part is collateral. So in the unlikely event that a borrower defaults on the mortgage and cannot repay, what do we fall back on so that we can sell an asset and provide our investors with their capital and their interest? Which
is the most important part, because it's the asset preservation aspect of our fund. Yeah.
So Paul, let's give a live example of a recently settled transaction so the people watching today can get a feel of the type of investments and opportunities they're likely to see from us.
Well, this particular borrower had come to myself and come to us. I've known him for more than 20 years. He's a great character. He needed to borrow money against an unencumbered asset for his business in a very quick period of time. We were able to facilitate that for him. We did it within a week. The asset is worth over $3 million. It's in a great blue chip suburb, and we didn't lend more than 25% against the value of the asset.
So hang on, that's very important to understand. So for our investors to lose money on that deal, that property had to drop 75%. And look at that net return. Yep. Because of the need for the money so quickly, our investors shared in a great, I think, market-leading return for risk. Yep. And that's what we do. 6.1% net per annum paid monthly.
The borrower has a great business, proven track record, great cash flow. And the number one question that we get from investors, why did they come to us? Borrowers come to us because of reliability, speed, and we understand what they require. So there's more to it than that. So in that opportunity, there's a great opportunity for our investors to participate in that mortgage.
So thank you very much for listening to us today. I hope you enjoyed it. If you want to see more from us in terms of investments, there's only one way to do that. Please email us at info@msqcapital.com.au. It should pop up on your screen, and we thank you very much.